Hey everyone, we need to talk about what just happened in the gold market because the mainstream takeaway is way too simple. Gold is sitting around 5,048 an ounce right now. And yeah, the move on the day looks small, down about 0.2%. But that's exactly why you should pay attention. When gold is camped above 5 grand and barely flinching, while the story behind the volatility turns political, that's when the real positioning happens behind the scenes. And here's the headline that's making the rounds. Treasury Secretary Scott Bessent is pointing the finger at China, saying unruly speculative trading in China is a big reason gold has been swinging so violently. If you own gold, if you're watching silver, or if you're just trying to protect your purchasing power, you need to understand what that kind of statement actually means. Because it's not just commentary, it's a signal. And the signal is this. They're telling you the volatility isn't coming from the usual place. Something bigger is happening beneath the surface. Let me show you the 3 things happening right now, because once you connect them, the next move in gold and silver starts to make a lot more sense. First, when a top U.S. official publicly blames foreign speculative behavior for price swings, it changes the narrative overnight. Markets don't move only on numbers. Markets move on stories. And once the story becomes, this is getting out of control in China, that opens the door to more scrutiny, more policy talk, and more uncertainty about what's coming next. Even if nothing changes tomorrow, the perception shifts today. And in markets, perception is positioning. Second, that China volatility explanation conveniently redirects attention away from the uncomfortable question a lot of people were starting to ask. Why did gold swing so hard in the first place? When gold is in what traders call price discovery, meaning it's pushing into levels where there isn't much historical reference, it becomes hypersensitive. Liquidity gets weird, stops get triggered, futures positioning gets crowded, and moves can accelerate fast in both directions. So if you're watching gold whip around near 5,000 and the official explanation becomes China speculation did it, you need to keep your guard up, because that might be partially true. But it also might be covering up how fragile the structure is when everyone is leaning the same way. Third, the most important part, silver and gold are not reacting the same way. Right now, silver is down close to 2% over the last day while gold is basically flat by comparison. And that divergence matters because silver tends to be the stress metal. When liquidity tightens or margin pressure hits, silver usually feels it first. It's thinner, it's more volatile, and it's more exposed to forced selling. So if gold is holding the psychological 5,000 line, but silver is slipping harder, that tells you something about how leverage and risk are flowing through the system right now. Put those 3 together, and here's what you get. A political narrative hits the tape. The market structure is already jumpy. And the more leveraged metal starts wobbling first. That's not normal volatility. That's the kind of setup where you can wake up one morning and the market has repriced before most people even realize what happened. Now here's what Wall Street analysts aren't discussing. When officials start talking like this, it often means somebody important doesn't like what the market is doing. And when powerful people don't like what the market is doing, you can see rule changes, margin changes, enforcement changes, or guidance that forces behavior without ever calling it manipulation. So I analyzed what this move is really saying, and I want to walk you through the evidence in a way that actually helps you. Let's start with the institutional behavior, because that's where the tells are. Smart money moved before the crowd noticed, and you can see it in where the flows are showing up. One of the most overlooked signals right now is what's happening in gold ETFs globally. Even when price action gets messy, stable ETF flows tell you something important. The bigger allocation crowd isn't panicking. They're treating dips like noise, not like the end of the story. And what really grabbed my attention is what's happening outside the US bubble. India just saw record inflows into gold ETFs. Record. Think about what that means psychologically. When everyday investors in a major country are choosing gold funds at record pace, at the same time gold is holding above $5,000, that's not fear of missing out the way it is in tech stocks. That's defensive behavior. That's I don't trust the currency story long term. Now I'm not saying that guarantees gold goes straight up from here. Nothing in markets is that clean. But it does tell you that real demand is still there, even at these elevated prices. And it matters because when the public gets involved, the market becomes less about a quick trade and more about a slow reallocation. Next, let's talk technicals, without assuming you're looking at a chart. Here's the simple version. 5,000 is a psychological number. Humans anchor to round numbers. Traders anchor to round numbers. Risk departments anchor to round numbers. When gold is above 5,000, the conversation changes from, is this rally real? To, how high can this go before it breaks? But when gold is below 5,000, the conversation flips to, was that the top? That's why holding above 5 grand is not a small thing, even if the day-to-day change looks tiny. And right now, gold is basically hovering above that line. That tells me buyers are still showing up on dips. It tells me someone is still defending that area. And in markets, defended levels tend to become battlegrounds before the next breakout or breakdown. Now compare that to silver. Silver recently had traders talking about $84 because that level became the emotional high watermark. And now silver is back down around 81 and change. When a volatile asset fails to hold a recently celebrated level, it often does one of two things next. Either it flushes harder, fast, brutal, get me out selling, or it bases, meaning it chops sideways, exhausts sellers, and then rips higher when nobody expects it. The problem is you don't get to choose which one happens. The market chooses based on liquidity, leverage, and who's forced to act. And that brings us right back to the China speculation narrative. Because if part of this volatility is being driven by speculative leverage and margin behavior, then the key question becomes, what happens if those rules tighten? If a lot of buying was being done with leverage, and that leverage gets restricted, you can get sudden air pockets. Not because the world stopped needing gold, not because inflation vanished, but because the mechanical buying power gets cut off. That's why when an official says things got unruly, your ears should perk up. It's not just blame. It's a warning that the system might push back. Now let's talk fundamentals, because this is the part that gets distorted online. Gold is not mainly an industrial commodity, it's a monetary asset. It's trust, or the lack of it, turned into a price. So when you see gold holding extreme levels, you're seeing a reflection of long-term anxiety, debt, deficits, currency dilution, geopolitics, and the credibility of central banking. And here's the point that matters for you. Even if you believe the China speculation story is real, that doesn't make the gold move meaningless. It can actually make it more meaningful, because if gold is still holding above 5,000 even after the market supposedly got unruly, that tells you the underlying demand is resilient. It tells you this isn't only a speculative blow-off. There's a bid underneath it. But the risk is the path it takes. The path could be violent. And a lot of people get shaken out not because they're wrong long-term, but because they're not positioned emotionally for the volatility. Now, I want to give you a historical parallel because we've seen this exact playbook before, where an asset starts making historic moves, officials start commenting, and the public explanation doesn't match the deeper structure. Let's go back to 2020. When the world shut down, gold didn't move in a straight line. It didn't politely trend upward. It spiked, it dumped, it ripped again. And what confused people is they'd see headlines like risk off gold up one week, and margin calls gold down the next week, and they'd think the market was broken. It wasn't broken, it was being forced. In that period, you had forced selling across everything to raise cash. You had liquidity stress, you had funding markets tightening, and you had a scramble for dollars even as confidence in the system was cracking. Gold ended up winning that cycle, but along the way, it punished people who couldn't handle the swings. Now, I'm not saying today is a repeat of March 2020. The catalyst is different, but the psychology is similar. When volatility spikes, the public wants a simple story. They're manipulating it. It's just China. It's just the Fed. It's just geopolitics. But the real story is almost always a combination of positioning, leverage, liquidity, and narrative control. And when officials start leaning into a narrative publicly, it's often because they want the public to look in one direction, while the system adjusts in another. That's why I'm taking this seriously. Because if gold can sit above $5,000 and the official story becomes foreign speculation is causing chaos, you're in a regime where policy, headlines, and money flows can collide fast. Now let's make this personal. Here's what this means for your portfolio. Most people watching this aren't trading gold futures. You're not sitting there with 10-to-1 leverage trying to scalp a move. You're trying to protect your savings, your retirement, your ability to pay for life. So let's translate the volatility into real dollars. If you own physical gold or a gold ETF and gold moves 1% at these levels, that's about $50 per ounce. 2% is about $100 per ounce. Now that might not sound crazy until you realize how quickly those moves can happen now. When the market is jumpy, a 1% move can happen in a day or in an hour depending on the catalyst. If you own, say, 20 ounces of gold, maybe through a mix of holdings, that's a $1,000 swing on a 1% move. That's not life-changing, but it's enough to mess with people psychologically, especially if the move is down and the headlines are screaming that the party is over. Now think about silver. Silver at $81 is even more volatile in percentage terms. A 2% move is more than $1.50 per ounce. A 5% move is over $4. If you're holding 1,000 ounces of silver, again, not crazy in this community, that's a $4,000 swing on a 5% move. And that's why silver holders feel whiplash. Now here's the contrast. The big players positioned months ago, They don't care about the daily candles. They care about the regime. They care about whether the public still trusts the system. They care about whether real rates stay restrictive. They care about geopolitical risk. They care about whether capital controls tighten. They care about whether the next crisis forces the next policy response. And that's what you need to think about too, not is today up or down, but are we entering a period where the rules can change quickly and where volatility becomes the price of admission? Because if we are, then the window isn't about catching the perfect low. It's about being prepared so you don't make a stupid decision at the worst possible moment. Look, the question isn't whether volatility continues. The math is clear. When gold is at levels like this, small policy shocks can create big moves because positioning is crowded and the narrative is sensitive. The real question is, are you positioned for what comes next? Right now, gold is around 5,048. That 5,000 handle is still the key psychological line, and the next couple of sessions are going to tell us whether this was stabilization or whether we're setting up for another leg of chaos. I share real-time updates and deeper analysis on social media. For those wanting exclusive research, members-only analysis, or early warnings, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the data speaks for itself. All right, before you go, 3 quick things. 1, drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think gold is headed by the end of the month? And where do you think silver lands first, back to 84 or down into the 70s? 2, if you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3, next video drops tomorrow. I'm covering the one data point that just triggered this China volatility narrative and what happens if the rules tighten again. Last time this flashed, the market moved before the headlines caught up. You won't want to miss it. See you there.